You think you've got time, that you can start investing next month, next year, when the market feels right. But what if I told you that every day you wait is silently erasing six figures from your future? This is not just about money. It's about freedom. The kind that lets you sleep easy, quit jobs you hate, and retire on your terms. And the scariest part? Most people lose that future. Not because they picked the wrong stock, but because they waited too long to pick anything. In this video, we're breaking down the invisible traps that delay your financial breakthrough. From missed compound interest to emotional mistakes that kill momentum, we're exposing the reasons most portfolios never take off. And more importantly, how you can break free starting today. Let's start. Part 1. The One-Stock Wonder Trap. All in on one? You might win or wipe out. Let's talk about the biggest rookie move in investing. Going all in on a single stock. Maybe it feels bold. Maybe it feels efficient. Or maybe you just saw some influencer say they're putting everything into one company because this one is going to the moon. But here's the thing. Putting all your money into one stock isn't strategy. It's gambling dressed up in a blazer. Sure, the story sounds great. One company, one ticker symbol, one big bet. And if it goes right, you're a genius. But if it goes wrong, you're toast. Because the truth is, even the best companies stumble. And when they do, your entire portfolio goes down with them. Think about this like driving a race car without a seatbelt. Yeah, you might go fast, but one bump and the crash is catastrophic. Now here's what the pros do. They diversify. That means spreading your money across different companies, different sectors, even different asset types. Not because it's flashy, but because it works. Diversification is your seatbelt. It's what keeps a market dip from becoming a total wipeout. And you do not need 50 stocks to make it work. Research shows that holding just 20 to 30 well-chosen stocks gives you most of the benefits. You protect your downside without capping your upside. And by the way, being diversified doesn't mean being boring. You can still have growth. You can still earn income. You just don't have to bet the farm on one name hoping it pays off. So if you've got all your money riding on one stock right now, pause. Step back. Ask yourself, do I want to build wealth or just roll the dice? Your future deserves a better plan. Start building a portfolio that's built to last, not just to impress. Part 2. Start small. Start now. You ever stand at the edge of something big and think, I'll start when I'm ready? Investing is one of those things people delay. Not because they don't want to do it, but because they think they need more money, more knowledge, more time. But here's the truth. None of those things matter as much as just starting. Right now, you can open an investing account with the same amount of money you'd spend on a pizza night. Seriously, with just $10, you can buy a fraction of a company that's been growing for decades. You don't need to wait until you've got a six-figure salary. You need a smartphone, an app, and the courage to click buy. Think about it like this. If you waited until you were fit to join a gym, you'd never go. You don't need to be rich to invest. You invest to get rich. And the best part? Those tiny investments? They're not tiny forever. They multiply. They snowball. Imagine you're filling a bathtub, one drop at a time. At first, it looks like nothing. But leave the tap running, and over time, you've got something real. That's how compounding works. Small, consistent moves now beat massive, inconsistent ones later. And while everyone else is waiting for the right time, your money is already working behind the scenes, silently, relentlessly. Don't wait for perfect. Don't wait for enough. The market won't send you a calendar invite when it's ready for you. You make the time. You start the habit. Because the biggest lie is that investing is for someday. The truth, it's for today. And if you've got enough for coffee, you've got enough to start. Part 3. Dividend myths debunked. Dividends are for boomers. You've heard the line before, dividends are boring, or that's something my dad invested in. And sure, dividends don't have the same hype as crypto or meme stocks, but here's the thing. They work. And the biggest myth out there? That dividends are outdated. Wrong. Dividends are your low-key wealth-building machine. While everyone else is chasing the next big thing, dividend investors are quietly stacking cash every single quarter. It's not flashy, it's just consistent. You want passive income? Real passive income. Dividends are how you get there. Because unlike that side hustle that needs your time, or that trendy stock that tanks overnight, dividends keep showing up, rain or shine. But here's what most people miss. It's not just about collecting a few bucks every month. Dividend investing is a long game. It's about finding companies that grow their payouts over time. That means every year your income increases, even if you don't add a single extra dollar. This is how people retire early. This is how they live off their portfolio without touching the principal. And this is why some of the richest, most disciplined investors, like Warren Buffett, love dividend stocks. And by the way, this isn't just about old-school blue chips. Tech companies like Microsoft and Apple pay dividends now too. The market is changing, and if you're not paying attention, you're missing the quiet revolution in cash flow investing. So yeah, if dividends are for boomers, then call me a boomer, with a paid-off house and a monthly check from companies I don't even work for. Because in the end, hype fades, but cash keeps flowing. And that's what financial freedom is really built on. Part 4. Avoiding emotional investing. Stay rational, not reactive. You know what ruins more portfolios than recessions? Not crashes, not inflation, not interest rates. It's emotion. That's right. Fear and greed are the real portfolio killers. Here's what it looks like. The market dips a little. You panic. You sell. Then it rebounds, and you feel dumb. So you buy back in at a higher price. Then the cycle repeats. You are not investing anymore. You are reacting, and reactions cost money. This is what they call emotional investing. It feels smart in the moment. It feels safe. But over time, it's the fastest way to bleed your returns dry. Let me put it this way. Imagine you're driving through fog. Would you slam the brakes every time your visibility drops? Of course not. You slow down, stay calm, and follow the road. That's how you survive the trip. Investing is the same. The fog is always there. Market noise, breaking news, social media panic. The investors who win, they don't flinch. They follow the plan. They zoom out. That's why having a plan is everything. Your portfolio should be boring. Your strategy should be clear. And when the world freaks out, you should be sipping coffee and rebalancing, not rage selling your entire account. Because emotion loves drama, but wealth loves consistency. So ask yourself, are you investing to feel something or to build something? Because the most successful investors are not the most brilliant. They're the most boring. They show up. They follow the plan. And they let time do what panic never will. Compound. Stick to your process. Let the noise pass. And remember, your emotions are loud, but they are not always right. Part 5. The copycat curse. But my coworkers doing crypto, you ever find yourself second-guessing your strategy because someone at work is suddenly an expert in crypto? Or your cousin's friend made a killing on a stock you never heard of? It's okay. Happens to all of us. But if you're constantly chasing what everyone else is doing, you're not investing. You're following. And that is how people lose money. Because here's the truth. By the time you're hearing about it, it's probably too late. The big gains? Already made. The risk? Still there. And guess who ends up holding the bag? Usually the last one in. aka you. This is what we call the copycat curse. Following the crowd feels safe, but it's actually the riskiest move you can make. It leads to knee-jerk decisions, panic buying, panic selling, and a portfolio that looks like a patchwork of hype and hope. You know what builds wealth? Strategy, patience, a plan tailored to your goals, not your coworkers, not your cousins, yours. So when someone says, "I made 10 grand on this one trade," ask yourself, did they really? Or are they just skipping the part where they lost 15 grand last month? Wealth is not built on trends. It's built on consistency. And most of the people flexing online? They're broke behind the screen. You want to win long-term? Focus on building an income-generating machine. Something that pays you while you sleep. Something that doesn't need market hype to grow. Because copycats chase noise. But real investors? They chase freedom. Stick to your lane. Build your system. And let everyone else chase the next big thing, while you build something that actually lasts. Part 6. The Quitter's Regret. I gave up when it got hard. There's this moment in every investor's journey. When the market tanks, your portfolio turns red, and your stomach drops. You think, this is it. I'm out. And that moment? It's the make or break point. Because here's the cold truth. Most people don't lose because they picked bad investments. They lose because they quit too early. Think back to March 2020. Markets were free-falling. Panic was everywhere. Tons of people cashed out. But guess what happened next? The fastest recovery in history. And those who stayed in? They didn't just recover. They made life-changing gains. You don't need perfect timing. You need endurance. Every time you bail when things get hard, you're locking in losses and cutting yourself off from the rebound. And that rebound? It's where the real money is made. Imagine climbing a mountain. The last stretch is steep, windy, and brutal. Most people turn around right before the summit. Not because they couldn't reach it, but because they thought it wasn't worth the pain. Now here's what you need to remember. The market rewards patience, not perfection. You will face downturns. You will feel doubt. But if you've built a solid dividend portfolio and you're playing the long game, the worst thing you can do is quit when it gets uncomfortable. Because the biggest breakthroughs usually come right after the biggest challenges. Don't be the person who almost made it. Be the one who held on and watched compounding, reinvestment, and consistency do what hype never could. Build true wealth. The market will test you. Your emotions will test you. But if you stay in the game, you win. Simple as that. Now here's the future me test. Imagine it's 10 years from now. Would your future self thank you for investing $20 a week starting today? Or for waiting until everything felt perfect? This isn't about being rich now. It's about building the kind of future where you don't have to worry. And the first brick in that future? It costs less than what's in your wallet right now. If you have made it this far, I have a powerful investing starter guide designed just for you. And it is absolutely free. This guide includes a simple step-by-step checklist to kickstart your investment journey, tips to avoid beginner mistakes, and even a printable tracker to stay consistent month after month. All you need to do is comment "Start Now" on this video. Once we hit 50 comments, I will drop the link so everyone can download it and take that first step toward financial freedom. Now you know why waiting for the perfect moment is the biggest myth in investing. But what if you are ready to start right now with $100,000? In the next video, I am breaking down what happens when you invest that money into the 5 best Fidelity index funds and how that could explode into serious long-term wealth. Trust me, you do not want to miss it.